Okay, great. Thank you. Happy to do a Your Stock Our Take on KITS Eyecare. The symbol is KITS on the Toronto Stock Exchange. And what KITS is, it's a vertically integrated direct-to-consumer eyewear company. So they retail eyeglasses and contact lenses through their e-commerce platform. They do have one brick and mortar store, but they're primarily an e-commerce business. And the way that they see themselves as fitting into the market is that they're essentially, by vertically integrating, they're able to take a lot of the costs out of the process and a lot of the time out of the process of manufacturing, assembling, and then delivering glasses to people. So they're able to offer glasses essentially with a shorter turnover time and also at a lower price relative to most comparables. So the company is trading right now at just over $10 per share. It's about a 320 million market cap company with 32 million shares outstanding. So this company has performed incredibly well, certainly this year. The company originally went public in an IPO in 2021. And then after that, growth was fairly meager, but it's really in 2023 that the company started to take off. And so far this year in 2024, it's been an incredible year for the company. They're up about 65% year to date, and we've seen good, solid revenue growth and market share gains as well. So full disclosure, before we go any further, I am actually wearing a pair of KITS eyeglasses. And Ryan and I did have a meeting with the company. We've actually had a couple meetings with the company, but we had one where we went down to their offices downtown. Then we went out to their manufacturing facility in East Vancouver. We did a full tour. We took a look at the operations. And then afterwards, a little while afterwards, I decided to test out the whole process by ordering a pair of glasses. These weren't glasses given to me by the company. I actually went through the full process of ordering them online, providing my prescription, paying for them so that I could see this from the perspective of the customer. So I do have some insight into the company as a customer. But going through the whole process, so essentially they have a manufacturing or assembly facility in East Vancouver that we toured. And what they do is they design their own frames. They have a designer, a full-time designer, that creates these designs based on what they deem to be trending styles. They have the frames manufactured, I believe, in China, sent to the company. So they have a big inventory of different types of frames. As well, the lenses as well, the raw lenses are also sent to their facility from an outside supplier. But what happens is when they get an order, they get the lenses and the frames from their inventory. They use these big machines here to essentially cut the lenses so that they will fit into the frames. Then they have other processes afterwards for assembling them, quality assurance. But these are big, expensive machines. I think they were like a couple $1 million each. They had 3 of them, I believe, maybe 4, if memory serves. So yeah, it was very interesting. And what I will say, certainly as a customer, is I thought that the experience was positive. These are good glasses. I would go as far as to say these are possibly the highest quality glasses I've owned. Now, in terms of price, I paid about $300 for them. I know that with a lot of the marketing that I saw, I was kind of under the impression that they were talking about selling glasses for $50. I believe that is just referring to the frames. So then there's always add-ons, lenses and whatnot. Now, I did for $300 take every additional option. So this has the auto tinting. It has the higher quality lenses, essentially everything. So I did pay the highest amount that one would typically be expected to pay, but $300 is certainly more than I was expecting. I will say though that it's still lower than I believe I would have paid through my optometrist that I was using before and the glasses stores that I went to before. And then I got the glasses in about a week. So I think that they were true on their promise of a quick delivery time. So I got a high quality pair of glasses in a week. There was a little bit of a delay due to quality assurance, but I still felt that I got them in a fairly reasonable time frame. So as a customer, I feel pretty happy. Now, in terms of as a stock, we want to look at this a little bit differently. And of course, we look at the business from a product and market perspective, but we also look at the business from a financial perspective. So let's take a look at the recent financial results that were recent full financial results, which was Q2 2024. and they reported sales of about 38 million, up 26%, adjusted EBITDA of 1.1 million compared to a loss of $500,000 in the previous year. Higher adjusted EBITDA margins, 3.5% compared to 1.7%. And then net income, just really marginal net income, just above break even, about 200,000 for the quarter compared to a loss of 1.2 million. So we're seeing positive adjusted EBITDA here, although margins are still fairly low. I mean, an adjusted EBITDA margin of 3.5%. We would want to see some further expansion in that margin, particularly given that we're expecting the company to, or we would like the company to drive more profitability to the bottom line. So certainly good, strong numbers on the revenue line. Nice to see positive adjusted EBITDA, but really marginal earnings right now, and fairly minimal adjusted EBITDA. The company did on October 3rd release its preliminary third quarter results as well. So it looks like revenue growth is continuing to be strong, actually accelerating, growing 34% to 41.7 million for the quarter. Adjusted EBITDA margin of 3%, so up year over year, but down quarter over quarter, and then still maintaining a strong cash position. So, the company's still coming in close to or around that break even in earnings, I believe it looks like from these numbers, but relatively low adjusted EBITDA margins still. So this is something that we want to see worked on, and the company is working on it. We've seen from some of the information that they put out, operating expenses as a percentage of revenue are declining. Revenue is increased, so it is moving in the right direction. But we still at Keystone, we're very particular about our criteria of a company being a profitable business, meaningful and sustainable profitability. We haven't seen meaningful profitability yet from Kits. Now, looking at the company's historic financial performance going back to when they IPO'd in 2021, they've about doubled the revenue over that period of time. Not really a lot of growth in revenue until, it was around Q3 of 2022 that started to ramp up, and that has accelerated recently. And then also at the end of 2022 is where we started to see the company produce positive adjusted EBITDA. Now, this is a great sign on its path to profitability, but adjusted EBITDA itself is not profitability. It does not account for depreciation, taxes, interest, capital expenditures. So we want to see actual real cash-based profitability. But even looking at adjusted EBITDA, if we were to look at a valuation basis on the company, you'd be looking at valuation about 93 times EV to EBITDA. Now, to be fair, the company is not being valued by the market on EV to EBITDA. The market is not even looking at the EBITDA right now, except to the extent maybe that it's positive as opposed to negative. But it's not. There's not a lot of focus on EV to EBITDA at the current time for Kits Eyecare. But for us, in terms of profitability, I mean, having meaningful EBITDA and a reasonable price to earnings, price to cash flow, EV to EBITDA multiple, something that's within a range that we would consider reasonable, that would be a requirement for us to invest in the company. Now, looking at it as a price on sales, it's about 2.2 times. That's reasonable. I don't think that that's unreasonable, really. But where we're really seeing the company fall short based on our criteria is on that profitability and on that EBITDA. So we can't really measure a price to earnings on this company right now because it isn't producing much in terms of earnings. So our take on Kits Eyecare, I do think that it is an excellent product. I'm very happy as a customer. I'm going to give them more of my money, certainly in the future. They also have potentially a very strong runway of growth. The company has been accelerating its revenue growth in recent quarters. And then they also state that they have up to 500 million in revenue in production capacity right now. So a lot of room to grow with their current facilities. So that strong momentum with the revenue, and then positive EBITDA is certainly a positive thing that the company has produced over the last 2 years. Now, adjusted EBITDA margins, on the other hand, are still quite low. So it's fairly marginal EBITDA, certainly very marginal profitability. They're just kind of starting to break into profitability. If they can expand those margins as they're growing the revenue, there's a lot of potential to drop more profit to the bottom line, but they need to demonstrate that they can do that, and that hasn't been demonstrated quite yet. So our take, it's a very interesting company. We liked the meeting. We will continue to monitor it closely, but it's not fitting our Keystone profitability criteria at this time. And until that happens, we couldn't make a recommendation on the company.
Yeah, exactly. I think you hit the nail on the head. Like, and even when they do, start, say they all of a sudden start, generating maybe EBITDA margins of 6 to, 8 to maybe 10%. Well, what kind of EV to EBITDA multiple would they demand, in the market? Obviously we have to analyze growth and, as long as they can continue to grow. But typically, a company with, a 10% or a 6% adjusted EBITDA margin will, demand a lower EV to EBITDA multiple. Again, it all depends on the growth rate and whatnot, but I think that that is something to keep an eye on when all of a sudden they do start generating more meaningful EBITDA. If they do.
Yeah, and I'd probably have to have another discussion with management just to kind of figure out what is a realistic upper bound for an EBITDA margin for that type of business? Because in a lot of businesses, you're kind of restricted just given the cost structure, the nature of the business, right? So I don't know, but certainly single digit EBITDA margins or operating margins are what we would consider to be a low margin business. Now, I'm sure that the company can improve from here. We don't know at this time what the time frame is or when that's going to happen. I will say that the company certainly seems to be getting a lot of attention in the market without the onus of actually having to produce profitability. So they may actually be of the perspective that why would we want to drive more profit to the bottom line when we can just invest more into marketing and operations and growth, right? Which is fine as long as you eventually, are able to drive that profit to the bottom line. What we have seen in the past is that often that just never ends up happening, right? That's always the intention long term, but it just never ends up happening. Sometimes it does. We hope it does with Kits.
Yeah, I know if Ryan was in here, he'd say a lot of companies that are just trying to capture that growth will all of a sudden make a culture within the business of, never focusing on the bottom line, which is something that we want to avoid.
Because it's not always an easy thing to do, particularly if you're a lower margin business. That means that then you have to really, focus on being a bit of an accountant and a penny pincher, right? And it's not a fun job, right? So, if it's a high margin business, you don't have to do that. But if it's a low margin business, you need to really focus on that.
It's fun for an investor when you see those cost savings programs, though, for sure, and then they start getting implemented. Sorry, Brett, go on though. I cut you off.
So just on the margin, you can generally use gross profit is obviously is still ways off of net income, but you can use a gross profit margin. In Kit's case, is hovers in the low 30% range, so 30 to 33% over the last 10 quarters. Mm-hmm. So then you can say, okay, I go from there, I look at the SG&A, and that's their major next grouped expense. How much do they have to bring that down? Because you can improve gross margin to a degree. You get efficiencies. You do get some economies of scale, but not normally to a great degree in a manufacturing business. It depends on the type of business. Sometimes they will have some sort of fixed cost in cost of revenue or cost of goods sold. But most time in manufacturing, you can't move that dial too much. So you really have an upper bound of 30%. Right now, their SG&A really takes that 30%. If they triple their business size, which would put them at that 500 million in revenue or so, it would be a bit less than that, but we'll just use triple. That would take the SG&A to 10% of revenue. From 30, you'd have a 20% operating margin. That's likely unrealistic, but there's your high in the sky, 20% margin, upper bound kind of limit. And that's what you can really use to ballpark these figures. And that's really would be the most optimistic. They don't have to increase SG&A, which they have as their revenue has increased, and you would expect that in a business. But there's your high in the sky estimate, 20%. But then realistically, you take that down from there, it's likely going to be, like Aaron said, low net income margin, low adjusted EBITDA, whatever margin you want to use. Maybe you could squeeze out a low 10, 11% double digit in the best case scenario, but that would be the optimistic scenario, which I would consider realistic.
And we don't know, if they ramp up revenue to 500 million. I mean, if they were to keep their fixed costs, if they were to keep their gross margins stable and their fixed costs stable, then you're going to have huge net income growth and margins there. But fixed costs aren't necessarily fixed. They just don't change directly with the number of units that you sell, right? So fixed costs are still likely in some areas going to increase. As they do that, you still have to have more customer service, more other costs as well will be added on there, probably more shifts of labor. So it's, yeah, I mean, it's very interesting. I'd like to see more net income.